This is the second video for Chapter 1. In the first video, we looked at the three study objectives labeled out in your textbook. In this video, we're going to look at study objective number 4 and 5. We're going to very specifically look at the financial statements, what's reported on them, and then very specifically looking at some vocabulary of the terminology used on the financial statements. And in the first video, we tended to have looked at the first three here: forms of business, uses and users of the financial statements, and business activities. In this video, we're going to look at the income statement, retained earnings statement, balance sheet, statement of cash flows, and the interrelationships. There'll be another short third video on other things in the annual report. So let's get started. There are four primary financial statements that comprise the set of financial statements. Those consist of the income statement, retained earnings statement, balance sheet, and statement of cash flows. Let's start by looking at the income statement. The income statement basically has two primary things that it reports: revenue and expenses. Revenue is the act of providing goods and services. And you want to think of it that way. Think of it as action-oriented. It's when the seller provides goods or delivers services. And as a result, assets will be received or it will reduce liabilities. But revenue is something that takes place. It's action. Likewise, expenses are an act of using an asset or service in order to generate revenues. So expenses, it's when something is used. An asset could be consumed or a service can be consumed, and that is an expense. Both of those get reported on the income statement. So let's look at an income statement. The heading is very important. It'll name the company, it identifies the financial statement, in this case the income statement, and it gives a time period. So in the heading, the time period is very important. So this income statement is for the month. And it's for the month that ends on October 31st, 2014. And that's very important. So if I'm reading this, I'll know that it's revenue for only a month. It's not revenue for a whole year or revenue for 1 week. And you can have income statements that report a year of activity or a week of activity. In this case, Sierra Corporation is reporting for 1 month. So again, the date is very important. And notice the big two, revenues and expenses, are listed out. Revenues, there's only one, service revenue, $10,600, and they put it in the far right, position it there. Expenses, there are numerous expenses that have been consumed: salaries, rent, supplies, depreciation, interest, and insurance. They list all of those out, draw a line to add them up, and then put the total to the right. So in the far right column, we have our basic income statement formula. Revenues of $10,600 minus expenses, $7,740, equals net income, $2,860. Again, our primary formula for the income statement is revenue minus expense equals net income. So let's look at the bullets over here. The income statement reports revenues and expenses for a period of time. That period could be a week, a month, a quarter of a year, or a year. Net income is when revenue exceeds expenses. Net losses are when expenses exceed revenues, which we don't want to happen, do we? And the past net income provides information for predicting future net income. So if we think about it, if the two primary external users of the financial statements are investors and creditors, they are using this past information, right, this past net income, to forecast or predict future net incomes. So what happens in the past often is used to forecast the future. Okay, the second financial statement is the retained earnings statement. And there are a couple of main activities reported on the income statement. One is net income, which we just saw on the income statement. That's the amount by which revenues exceed expenses. Sometimes it's referred to as a company's profit or its earnings. So you kind of have to get used to the jargon. There are various synonyms meaning the same thing. Net profit or net earnings or net income all refer to the same thing. Net income belongs to the owners, which are the investors. Remember, if it's a corporation, the investors are the shareholders. So you can imagine profits belong to the owners, right? Then, if the corporation wants to distribute those profits, that's called a dividend. Dividends are a distribution of the earnings, or profits, to the shareholders. And usually these dividends result in a cash payment from the corporation to the stockholders. And usually those take place quarterly, or although it can be once a year. So let's look at where we're at right now. We've already talked about the income statement, and the bottom line of the income statement is arriving at this net income. Net income will flow into retained earnings. Think about it. What this financial statement is labeled, it's an earnings statement. Earnings, though, that are kept or retained in the business. So net income is our earnings. So this year's earnings will flow into retained earnings. So retained earnings start with what we had at the beginning of the period. In this case, it's for a month of October. So at the beginning of October, the company had not retained any earnings. We add in this month's earnings, or net income, $2,860. We subtract dividends, which are a distribution of earnings. So we're going to pay $500 of the earnings to the shareholders, and we will end up with ending retained earnings of $2,360. Okay, so we can see then that in our sequence of financial statements, one has to first prepare the income statement first, and then second, retained earnings statement, because I couldn't prepare the retained earnings statement if I didn't know net income. Also notice, both of these financial statements are dated the same for the month ended October 31st, 2014. So both cover a period of time. Okay, so here we have the retained earnings statement all by itself. I kind of went over that on the prior slide, so I won't do that again. Let's look at what the bullets say. This statement shows the amount and causes of changes in retained earnings. Retained earnings will change because we have new earnings or new net income, and it will also change if we distribute some of those earnings in the form of a dividend. The time period is the same as that covered by the income statement. So both the income statement and retained earnings statement cover a period of time. They're kind of like a motion picture. They cover a period of time. And then users can evaluate the dividend payment practices. We can see from this retained earnings statement, the company has paid a dividend, so that might lead us to think they'll pay dividends in the future. Now let's move on to the third financial statement, the balance sheet. There are three primary elements on the balance sheet. Well, first one are assets. And we've discussed this in the first video. Assets are resources owned by the business. Can include things such as land, building, equipment, vehicles, and supplies. But the resources, and they haven't been fully consumed or used yet. Liabilities are obligations of the business. They represent amounts owed to creditors in the form of debts and other obligations. Usually, liabilities will end in the word payable. Notice accounts payable, utilities payable, notes payable. Stockholders' equity represents the residual interest of the owners, stockholders. So let's look at our primary accounting equation. There actually are two. First one is assets equal liabilities plus stockholders' equity. Assets are resources of the company. Liabilities are obligations of the company. But another view of it, another way of thinking about liabilities, is that they're the creditor's claims to these assets. Yes, the company owes creditors, so the creditors have rights to some of these assets. And lastly, stockholders' equity is the residual interest of the assets. So that's the owner's claims to the assets. If you think about it, there's assets, there's the creditor's claims, stockholders' equity then is the residual, what's left over. So there are two claims to the assets, creditors' claims, owners' claims. And I hope you're seeing a big picture here of what we saw in video 1, where we have two primary users of the financial statements. Creditors, their interests are conveyed in liabilities, and then we have the investors or stockholders, which is conveyed in stockholders' equity. And both of these parties have claims or rights to the assets. Okay, on the balance sheet then, let's look at its heading. Again, the name of the company identifies the financial statement, but the date is very much different. The balance sheet is always dated at a point in time. So at October 31st, 2014. It's really, want to think of it as a snapshot. You know, you've got your snapshot camera, click, click, freeze time, click, click. Here's what the financial position of the company looks like. So whereas the income statement and statement of retained earnings covered a period of time, like a motion picture, the balance sheet is a snapshot of the financial position. So we have our big three: assets, liabilities, and stockholders' equity. So assets, we list those out, add them up. Notice there's two lines at the bottom. Liabilities, we list those out, add them up. Stockholders' equity, there's usually two: common stock, which represents stock that has been issued to shareholders, and retained earnings. Retained earnings represents net income that's been retained or kept in the company. And then we add up stockholders' equity. On the far right, then, we have liabilities plus stockholders' equity and add that up. And then we have our accounting equation. Total assets equals total liabilities plus stockholders' equity. The other thing I want to point out is how retained earnings, we saw for the ending retained earnings, or the October 31st balance of retained earnings on our retained earnings statement. That financial statement has to be prepared before the balance sheet. So notice how this $2,360 on the retained earnings statement, it flows into the balance sheet. So both of those, this is the balance at October 31st. Here's the balance of retained earnings at October 31st. Okay, so let's look at our bullets here. The balance sheet reports assets and claims to the assets at a specific point in time. Assets equal liabilities plus stockholders' equity. And it lists assets first, followed by liabilities and stockholders' equity. Okay, the fourth financial statement will be the statement of cash flows, and we can see it's somewhat connected to the balance sheet. There's a cash account on the balance sheet, and by the way, cash on the balance sheet, really that's probably the company's checking account. It's cash in the bank usually. So that $15,200, that's probably the balance in the company's checking account. That will be reported both on the balance sheet and this ending cash balance on the statement of cash flows. So let's move on to the statement of cash flows. Let me back up just a minute. Notice on the statement of cash flows, that's where we're very specifically going to see the three business activities: operating, investing, and financing. So cash flowing in, cash flows out, right? Cash comes in and I deposit it in the bank, so deposits are cash in. Cash goes out because we write checks, so cash flows out. So this is all cash coming in and out because of operating activities, cash coming in and out because of investing activities, and cash coming out in and out because of financing activities. So let's review those three business activities that get reported on the cash flow statement. First off, if a company is just taking off, or if it wants to expand, it will finance with debt and equity. We can borrow money from the bank, or we can receive cash from the stockholders by issuing stock. Either way, cash is coming in from debt and equity finance. We'll take that cash and invest in the business assets. So we might buy vehicles, we might buy buildings, we might buy land, we might buy equipment. And then we're going to start our operations. will use these assets and other services to generate revenue. Usually that's sales revenue if it's a retail company. And revenue will ultimately result in profits or net income. And when we have profits or net income, that usually satisfies the investors and creditors. So when we break out the three categories, you can see we have our financing, our investing activity, and the rest of that is all operating activity. So on the let's start with the operating activities. This company lists cash receipts from operating activities. That's really cash received from sales. Cash receipt from sales, or really often sometimes labeled cash receipt from customers, because if we sell goods and services, we ultimately will receive cash from our customers. So often this is cash receipt from customers, cash paid for operating activities. So typical operating activities would be, utilities, wages, advertising, taxes, did I say utilities already? And all of that sort of thing. And so cash will be paid out for that. And again, it is the cash paid for those items and the cash received from that. Investing activities. We invest in our long-term assets. So in this case, they bought office equipment, so cash went out. And then the last category is financing activities. So they received cash by issuing stock. They received cash by issuing a note, which means they borrowed money from the bank. And they also paid a dividend. So they paid cash to their investors, $500. Can we subtotal each of those here on the far right column? Add it up. Add that increase in cash to our beginning cash balance of 0, and that's our ending cash balance. So the statement of cash flow answers, where did cash come from during the period? Well, it came from revenue type activities, or our customers. It came from issuing stock, and it came from borrowing money from the bank. Second question, how was cash used during the period? Well, we paid for various expenses. We paid and bought office equipment, and it helped pay for a dividend. And lastly, it will answer the cash flow statement will answer what was the change in the cash balance during the period. Cash went up $15,200 during the period. The last thing I want to go over is the heading of the cash flow statement. Again, it's very similar to the others. Name of the company, identify the financial statement, and then the date. This financial statement is dated just like the income statement and the retained earnings statement because it covers a period of time. So you have to identify what that period of time was.